This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow the podcast on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you are listening to episode 37. When you get a chance, if you like what you hear, it would be awesome if you rate and review the podcast on iTunes. This really does help because I would love the feedback. For this episode of the Planet MicroCap Podcast, I spoke with Nate Tobik, founder and CEO of CompleteBankData.com and author at OddballStocks.com. I've been following Nate's blog for some time now, and I reached out because one thing in particular that Nate covers on his blog that we haven't discussed on here yet, and that's the banking sector. Also, I could relate to a lot of what Nate said in this interview, especially when we discuss reading investing books. It's important not to feel discouraged when reading these books. Rather, write down terms and phrases you don't know and look them up on Investopedia. That's what I did, and quite frankly, I still do that. The goal for this episode is to learn more about the banking sector, not to get discouraged when first reading investing books, and discuss a few investing phrases we've yet to cover until now. Thank you again for tuning into episode 37 of the Planet MicroCap Podcast. Please enjoy my interview with Nate Tobik, but first, a word from our sponsor. Hey everybody, Robert Kraft here, your host on the Planet MicroCap Podcast. I'd like to take this moment to invite you to join me and some of the guests you may have heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 26th through April 28th, 2017 at none other than the Planet Hollywood Resort and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you'll get to meet privately in one-on-one meetings with company management of undiscovered and well-known microcap companies. There are a lot of surprises in store, and you're not going to want to miss it. So join us at the Planet MicroCap Showcase, April 26th through April 28th at the Planet Hollywood Resort and Casino in Las Vegas. For more information, go to www.planetmicrocapshowcase.com and register now to reserve your spot. See you in Vegas. For this episode of the Planet MicroCap Podcast, I have Nate Tobik on the program. He's the founder and CEO of CompleteBankData.com and author at OddballStocks.com. Nate, welcome to the Planet MicroCap Podcast.
Hey, glad to be here, Robert. Thanks for having me.
It's my pleasure. Thank you for coming on. So before we get into the nitty-gritty, as we do with each guest that comes on the program, let's start with your background and how you got started investing in microcap stocks.
Right. So I took a very winding road to get to where I am. And, I had no interest in finance or investing when I was in college. A lot of people start out going into finance. Something just piques their interest. And I had none. I took one economics class in college that I barely got a C in because I only showed up for the test. And it was just so boring. And I just didn't care about anything with business. It had no interest to me, which is strange because I was very entrepreneurial in high school and in college and after college. So I ended up getting a degree in computer science, and from that I worked at a startup and was kind of always exploring other business ideas on the side, which I never made the connection that this had something to do with investing or business. I just thought they're two totally separate things. So, long story short, I had been given a little bit of money from my grandfather who was really interested. He made his money running a business and investing, and for years I would get brokerage statements. I had no idea what I owned or what I was doing. And so one day I just decided I should figure out what this was. And so, started to learn, read a lot of books. Fast forward a couple of years, I liked the idea of investing and actually practicing it so much. I thought, well, I'll get a job as an equity analyst, and did some networking things with investors here in Pittsburgh. And someone recommended, they said, oh, you should take the CFA exam. So I took the first and the second exam, and I learned a lot about kind of the bedrock type concepts in finance. And I failed the second one, and I found out I failed it while we were on vacation in Florida. And I was sitting down by this pool just kind of thinking about all this stuff. And I thought, if I took the time I was spending studying to be an equity analyst and to get the CFA and use that to just invest my own money and do the research, I would probably come out further ahead than if I switched careers. Because if I switched, I was going to have restrictions on what I could buy and sell. And, just that would now be my job. And so I wouldn't have as much freedom. Mm-hmm. So that's the route I went. And in doing so, I'm not a very structured person. I guess you could say, like, I'm the type of person who we're leaving for vacation in 3 hours, and I'm just getting the suitcase out to finally pack it, and kind of a last minute. So I needed a place to keep my research. So I started a blog, Oddball Stocks, and as I was looking at companies, I started to write on there. And I learned over time that I enjoyed writing, and I enjoyed digging into smaller stocks because no one else is looking at these. And, that's kind of a misnomer in some ways. That's what I had always thought, because there wasn't a lot of information out there. But the reality is there are a lot of people looking at small stocks, and it's just a matter of you need a place to connect with those people. And from there, that's how I got into to microcap stock investing.
Mm-hmm. And what is your strategy when assessing a potential new investment? I know that's a big jump there from how you got started, but the reason I guess I'll put it in the context of what was the first company and I was going to ask you this later, but I'll ask you it now, that you really sank your teeth into, and that helped shape your investing strategy. So I guess the question being is a two-parter. What's your overall strategy when looking at a new investment? And then what was the experience that helped shape that?
Right. So I guess I'll go back to how I got into this, because they're really linked together. So when I was learning about investing, I didn't know the first thing from the second thing. So I just went to the library and found the aisle of books with investing and just started checking them out. And I would just check these books out, and some of them would be on fundamental investing. Others were, the chart reading. I remember paging through that Beardstown ladies book when I was in the library. Just anything they had. I just, that's where you go to the library. And so somewhere along through that learning process, I realized I liked buying value stocks. And I think that's just based on my character. So I like shopping the clearance bins. I like looking for bargains. I like looking for good deals. If I find a $100 pair of wool pants for $15, that's like, that's a bonanza. And and I enjoy that. So it just seemed natural that you could apply those same bargain shopping ideas to investing and investing in these value stocks. But as a beginner and someone without much business analysis understanding, when I read things like in The Intelligent Investor, he'd talk about the defensive stock portfolio or the enterprising investor portfolio. He was talking about really analyzing businesses and saying this business is, maybe they're going to be doing 20% growth on their sales, and earnings should be at a certain multiple, and the current price is half of that. So that's situation where I could understand why, when a company was spun off, it would trade lower than what it should trade. And so I got started doing a lot of spin-offs and other special situation type things, whatever was around, and this was in 2005 and 2006. And I kept doing that up until the financial crisis. And somewhere in that period when I was reading about spin-offs, I ended up on this guy's website, Fat Pitch Financials, and he would talk about net nets. And then I went down that rabbit hole of reading about these net stocks and low price to book value stocks. And those concepts all made sense to me. And they just made intuitive sense that if a company is selling for half of their book value or less than all of their liquid assets minus other liabilities, it should just be worth more. And so I started to invest in these things. And I was always interested in those ideas, but the biggest barrier was really finding information out about them. And I didn't have a Bloomberg or any sort of tools that I could really dig these names up. So it was like any scrap of information I could find in 2007 I was kind of going down the rabbit trail on these things. And so, I was doing spinoffs. I did well with spinoffs, and I'm not sure I could really attribute that to me knowing what I was doing. I was just in the right place at the right time. And then the same thing happened with a lot of these value stocks. I was looking at low price to book stocks and net nets, and the financial crisis happened, and there was a ton of these things. And so I was buying these stocks at the time that were just cheap. And I remember, so the first net I bought was, I don't remember the exact date, but it was right in the middle of the crisis. And someone had written about it on a blog, or the name came up somewhere, and I found it. And I was looking at their filings, and it was almost all cash. And the cash minus their liabilities was something like 50% more than their market cap. And I just kept reading this report over and over, and I kept thinking to myself, what don't I understand about this? Like, what is the piece of information that everyone else knows that I don't understand? And, it turned out that there was nothing, that it really was mispriced, and the stock then went and doubled, and I think it doubled again. But I couldn't, it didn't make sense. It was like everyone else must know something that I don't know. And I remember that was such a kind of a pivotal moment, because I learned you have to trust your own gut. And I looked at it, the numbers didn't make sense, and I thought, well, I'm just going to buy this because it has to be worth more. I'm not sure what other people see in this that I don't see, but that was where I trusted my own gut and went forward with it.
Hey, Nate, by the way, for those who don't know, what does net mean?
Right, so a net it's a stock that's selling for less than its net current assets. So if you take the current assets of a company, which is like their cash, their receivables, their inventory, other current things, and a current asset is something that could be liquidated within a year, presumably. That's the definition. So you take these current assets, which are mostly liquid, and then you subtract all of the company's liabilities. So that would be all of their current liabilities plus all of their non-current liabilities, so long-term debt, leases, and anything that they have. And when that residual value, the current assets minus all liabilities, is greater than the market cap, that's considered a net. So what that number is saying is, essentially, if the company were to sell all of their current assets, pay off all of their liabilities, it's worth more than what the market is ascribing to them as value. And then they might have some non-current assets with some other value as well. And those are great stocks to get into if you could find them where the company is not destroying their own value. I like the idea of a net as it's kind of like a marker for investors, I guess you could say. So it's this sign in the market that says, this is trading at an extreme valuation. It's worth looking at. It doesn't mean that every single one of them is investable, and it doesn't mean that you should be investing in them or the price is always wrong, but it just says this is something worth looking at. It's an extreme valuation.
Mm-hmm. And another question I wanted to ask, having to do with your with your answer that you just said, having to do with and I've never asked this of anybody who's picked up Intelligent Investor or One Up on Wall Street, because I experienced it where I would read through it and some of these concepts I didn't get right away, and there were times where it was somewhat discouraging. I mean, did you have those similar experiences, and what helped you push through that?
Yeah, absolutely. And so I read The Intelligent Investor, and I didn't quite get a lot of it, but I got the general gist of it. And then I thought, well, I should read this other book, Security Analysis, and I picked it up, and I read through it, and it was like reading through the encyclopedia. It was just so difficult to read. Well, it turns out the reason that was true is because I didn't have the experience in the background to really make sense of it. So I read through this. I think I read Security Analysis in, I guess it would have been 2006. So I'd been investing for maybe a year, and it just didn't make sense. And then so I invested for a number of years. And in 2011, I decided, I should reread this book. Mm-hmm. And I read the 1941 version, and the previous one I read was from the 50s. And I loved it. I mean, I was going through it. Everything made sense. And the book was enjoyable. I read it really fast, which is crazy because it's 600 some pages. And then I went back and I thought, well, maybe it was the version I was reading. Maybe the 1941 was just better. And then I read the other book that I had. And guess what? The words left off the page this time because I now had the experience and the knowledge and the background of how the market worked that the book made sense. And it was interesting. So it's like you could read something and it has almost no meaning to you until you really get your hands dirty, and then you can go back and reread the same words, and it's like they come alive.
Mm-hmm. Yeah, that's actually what I feel when I've been reading a few, I like a few of the books that are classics that I just hadn't read yet, that I just actually recently picked up and started reading, and I'm like, oh, this all now makes so much more sense, and you end up just breezing through it.
Yeah, that's definitely true. Yes. Mm. Yep.
All right, so I want to take a quick pivot here because, one of the things that we also haven't really talked about on the podcast, and, sometimes we get into specific sectors as places to look at that, again, we just haven't covered. And one being, especially that you'd cover that since I've known you, is you do cover a lot of the banking sector, regional banks, community banks, basically microcap companies in banking. So, for those who don't know, can you provide an overview of this sector and why it's interesting to you?
Sure. So for anyone who isn't aware, I run a software company, CompleteBankData.com. And what we do is we take financial data about banks and financial institutions, we aggregate it, and then we have a suite of tools built on top of it to provide analytical insights to investors and bankers. And so in running that, I got into banks because banks were a good investment post-crisis, and then I started this software company, and so now it's my job to know this sort of a thing, and so I've really learned the space, and so what's interesting about banks is a lot of people avoid banks and financials because the accounting is a little different than industrial companies. And there is a learning curve to understanding how bank financials work. But once you get over that learning curve, I think it's worth it. So, if I were to use an analogy, it's like hiking up a mountain where the hike really stinks and your legs are burning and you're out of oxygen. But once you get to the top, the view's worth it. And I think that the same is true for banks because, ultimately these companies are all the same. They're all doing the same thing. So they're taking customer deposits in a geographic area, and then they are reloaning that money to businesses and to borrowers in a geographic area. And you could compare them directly against each other. So a bank that's in Iowa is doing this local lending and local deposit gathering, and a bank that's in Connecticut is doing the same thing. And so you could kind of compare these and say, these guys are doing it better on these metrics and these are worse. What I like about banks, and especially smaller ones, is they give you exposure to a part of the market that you can't invest in directly. And so what I mean by this is, for microcap stock investors, there's a few thousand, 5,000 or 6,000 microcap stocks, I think. And you can buy it through a brokerage. Well, people like microcaps because you're getting exposed to a segment of the economy where there's growth, there's hyper-local dynamics, all these things that don't exist when you're buying GE. And when you look at a local economy, you have small-town restaurants, you have builders, developers, you have local companies, and there's no way to invest in these local companies directly. But banks are making loans to them, and the bank is making interest on the loan, which is essentially a return for the risk they're taking. And as an owner in these banks, you could share in the profit of what's going on in the local economy. So by investing in a local bank, you're investing in the local market of that area, and you really have exposure to all of these businesses that you can't get otherwise. And, so if you scale that up, you say, okay, well, maybe I don't want exposure to, a mom and pop restaurant. Well, that's fine. If you invest in a regional bank, the regional bank is making their loans to bigger private companies. And, if you think about it, most companies in the U.S. are private. And so banks are giving you exposure to these companies that you don't have any exposure to otherwise.
That's really interesting. I never really thought about it like that. Because you're right in a sense, that each community bank, they're there to support the local economies. So what I would then want to know is when it comes to doing due diligence on these banks, you mentioned one thing when you can directly compare one regional bank to another, but there must be other things that you have to also consider, like, Iowa versus Connecticut, two very different populations, two very different, places in the United States. Like also, do you have to consider interest rates? I quite frankly don't know too much. So, what are some of the other things that you also look for when evaluating this space?
Right. So those are great questions. So I'll tackle the question that trips people up the most first, and that's, do you need to dig into the local economy? And I think when you look at banking, you have exposure to these local areas and regional areas. At the same time, people get tripped up and they think, I need to understand the dynamics of Iowa versus Texas versus Connecticut. I need to know that. And that's a fallacy, because the people who need to know that are the bankers who are doing the business there. Mm-hmm. And what you need to know is how to evaluate how effective these bankers are at doing their job. So, the number one thing in banking is they're leveraged institutions, and what you need to be able to evaluate is average loans and they avoid losses on their loans, that becomes an above average bank. And so what the most average has to do is just make sure that they're not making bad loans. And bad loans are things like when there's a construction boom and there's a shopping center going up 15 miles outside of town that's speculative, you don't want to be invested in the bank that loaned those guys the money. That's bad. Or banks that will concentrate their lending on one thing. So you have a bank that says we're all in on X business, and then that business has a problem in that area, the bank takes a huge hit. So you want some sort of a diversified lending, and then you also want a pattern of good lending. So you could look back through history and you could say, if there was a bank that was profitable in 2008, 2009, 2010, and they didn't lose money, they didn't have crazy write-downs, I think that their history says they know what they're doing. This bank is making prudent loans. And so you want to, that's first and foremost, you want to protect against a capital loss. And if you can protect against a capital loss, then a lot of the rest of the work is easier. So now what you're measuring is the quality of how these people run their business. And what that is how efficient are they with operations? Do they have a lot of unnecessary expenses? And that's captured in the efficiency ratio. You want to see their net interest margin, which is their interest income over their interest expense. So that's interest income is money coming in from loans and securities, and interest expense is what they're paying to fund themselves. So money on deposits, money on debt. And that shows, in some ways, that could give a peek into if the bank's taking unnecessary risk. So if all the banks in the U.S. their net interest margin is 3.6%, and then you've got a bank making 7%, it makes you wonder what sort of loans are they making that they're able to make a bigger spread. So you have a net interest margin, and then out of that you have operating expenses, the efficiency ratio that falls down to on the financial statement. Now you have your operating income, and then taxes and your net profit. And if you take your net profit and you divide that into your assets, that's your return on assets. And in general, about a 1% return on assets is considered the benchmark in banking. You want to be around there. And if you take that net income and you divide that by your equity, that's your return on equity. And most banks they would like to be earning 10% on their equity. That's kind of so a 1% ROA and a 10% ROE that's the benchmark of this is a decent bank. So in the U.S. now, somewhere around 30% of banks hit that threshold. So if a bank is doing 10% on equity, it's in the top third, roughly. So I'm looking at these different metrics. So I check for lending, and then I'm checking how efficient are they in operating. And I like to look at how they are, what their deposits are made of. So deposits are like a free funding source or a very cheap one. If you think about, any sort of other company like a clothing retailer or something, if they need money to fund their business, they can't just hang a sign outside that says, give your money to us and we'll give it back to you with a little bit thrown on top in a couple weeks. They have to go borrow it or they have to earn it. A bank can hang that shingle out there and say, just give us your money, trust us with it, we'll give you back your money plus a little bit. Nowadays, we'll just give you your money back and a few extra pennies on top of it. And people do. And so, you want banks to have as much business. You want a lot of business deposits. And the reason for this is when a bank does a business loan in general, this is just in general, what they'll say is you need to keep a certain amount of deposits at the bank. So, that's just kind of their rule. So say a business wants $1 million loan, and maybe they have to keep $50,000 on deposit. And so in essence, what the business is doing is for that $50,000, they're not getting any interest. And they're actually paying to get their own money back in the form of a loan. And so business lending like this is really, the business lending is good because it brings in business deposits, which are pretty much no-cost deposits. The next best deposit would be like a checking account where you're not getting any interest on it. The worst type of deposits are savings accounts, and that's savings accounts that pay an interest rate. But even worse than that are CDs. Mm-hmm. And a CD, it's because the type of people who buy CDs, they're shopping for rates. The money's locked up at a higher term rate, and the bank has to pay they have to pay more interest on these CDs and savings accounts. So you want to look for a bank that has a good mix, mostly low cost deposits, and then you do the same thing when you look at the lending. So a good lending mix is there's some residential loans, there's some multifamily loans, there's some business loans. Maybe they have some construction loans, but it's not 70% of their loan book. It's just a diversified lending mix. And if a bank is non-diversified, you want them to go either two ways, which is you want them to be a commercial bank, which is just a commercial lender, so it's all commercial loans and all business deposits, and they specialize in that. And there's some great banks that do commercial lending, or more of a thrift. And a thrift is more than 60 or 65% of their loans are residential mortgages, and it's basically just they're loaning to homeowners. So in both of those profiles, it's easy for the bank to manage their risk. And there's certain types of people they could hire who a commercial lender is, they're hiring basically credit analysts. And, a residential lender it's different, especially because they're able to sell a lot of their loans off. But regardless, those are the routes you want to see a loan book take. You don't want to see a bank that has a ton of construction loans, or some go really far out in other things like credit card lending, and some are really in auto lending, which I'd be wary of right now. And so it's kind of interesting. Like, I guess the point on the loans and the deposits is the actual percentages of loans and deposit types are going to vary between banks. But when you look at the deposit makeup or the loan book makeup of a bank, what you're looking at is it's the imprint of the people who run the business on their bank. And you could understand a lot about how the managers think and how they view their businesses and how they view risk by looking at these without having to ask them. So a bank that doesn't understand risk and interest rates, right now, their loans are all 15-year plus loans. And there's banks like this. And when rates go up, they're going to get slaughtered because the prices are just going to, the market on those loans is going to drop like a rock. Mm-hmm. And you could understand that by just looking at the financials and not having to call the guy up and say, hey, what do you think about interest rate risk? Because everyone could give you a snow job for a couple minutes and tell you what you want to hear. But when you look at the financials, you could say he doesn't understand it. That he went out 15 years on the loan book when most banks are keeping it really short right now with interest rates. They're at a couple. It's like 1 to 3 years at the most for almost all banks.
Mm-hmm. Well, I got to say, Nate, you just provided a serious overview of the banking sector. I guess my main question to follow up is, what's the main thing that you'd like my audience to kind of take away when assessing this sector and approaching it when wanting to maybe make an investment in a banking stock?
Yeah, so I would say first and foremost, if you've never looked at a bank, you shouldn't be scared to look at one just because the financials are different. Mm-hmm. And read through, and what I would say is try and model in your mind how the money would work, how this business works. So they take customer deposits, they pay a little bit on that, then they lend the money back, they earn some interest on the loans, and then there's this difference between what they earned and what they paid. They pay out their expenses, and then they earn a profit. And then how does that translate to a balance sheet perspective? And just walk through it slowly. You know, this stuff is not rocket science. It's not particle physics or anything. You know, I think if I could understand this, I think anyone could understand this. And you just have to approach it with an open mind. And then once you get in there, there's so many banks. There's around 1,200 banks with tickers in the U.S. Mm. And I think a trap a lot of people fall into, and I'm speaking for myself because I've done this so many times in the past, is when I'm presented with a lot of something, I think I need to find the best one or the best two, and it's that like analysis paralysis. So now I have 1,200, and I'm trying to figure out what's the absolute best one. Instead, I would say develop some rough valuation guidelines and say, I'm only going to invest in banks that are growing at a certain rate a year or under a certain price-to-book metric or price-to-earnings metric. And then within those, buy a few of them and just kind of watch them and see what happens. So there's so many banks to choose from. You don't have to own the best bank because you'll spend so much time trying to figure this out. You'll never get to the answer. And it's better to buy a couple banks that meet an acceptable criteria mm-hmm. versus endlessly researching for the absolute best.
Mm-hmm. All right, Nate. So we're taking another pivot here, and I wanted to cover some of the articles from your blog roll because you write some really some very quality pieces on there. And the first one that I wanted to talk with you about because this one really stood out to me because in my experience and I think the experience of a lot of other investors is that they find their new ideas via screening, screening for stocks. I mean, I did a whole episode on it for the podcast. And so one of your posts was, and I quote, "Is screening completely worthless?" So I wanted to get your thoughts on this. And if it's not really a great tool, what is your strategy when looking for new investing ideas?
So I don't think it's worthless. I like screens. And I mean, people find ideas all sorts of ways. So I've bumped into stocks. And by that, I mean, I am reading about something, some news article, and then there's something in it that piques my interest, and I'm reading about Wikipedia on it, and down this rabbit trail of internet surfing, and I'm at some company's investment relations page, and I find out that they're an attractively priced stock. You can't systematize that. That's just random. And I know a lot of people get stock ideas from what I write about. So, I think reading about what other people have written is great, and it's a great way to find ideas. Especially, I like finding ideas that someone I trust has said this is worth looking at because they've already vetted it. But I love to screen for ideas as well, and I guess I would say I screen a little differently than what most people think of when they think of screening. And so I think a lot of people say screening. No one screen. You shouldn't be screening stocks, and they're attacking a straw man because they're thinking of this mythical person who I've never talked to or met yet, mm-hmm. who says, I want to find a stock with a 10% growth rate that's trading at 10 times earnings, that has 50 employees, and it has 2 factories in California, and the last 5 years it earned 15% on their equity, and the CEO is 60 years old at least. And when you read like investing books, those are always the type of examples they use, and they say, oh, and then, how could you do that? Because now you've limited your universe of stocks, which you can, and there's no one out there who could create fine-tuned criteria like that that's actually successful. But what I like to do is I like to say, look, I'm never going to invest in a stock that is trading, that has negative equity and has been losing money and has no sales. I will never invest in that. And so I could create a screen and say, I only want companies that are profitable. And then I could say, I'm not interested in buying something that's 50 times book value or is at 300 times earnings. And, for every one of these things, someone could make a case. They could say, well, then you would miss Netflix or you would miss some other company. And that's true. I would miss Netflix or whatever else I would miss. And the thing is, I don't know how to evaluate tech companies that are, like venture capital investments. I just don't know how to do that. That's not my personality. I know how to look at a company and say, is this a cheap valuation right now? Yes or no? And go from there. So I create a broad screen that says, I want stocks trading below book value, and I want them to be profitable, and they need to have a 5% return on equity. Mm-hmm. And then that'll, a screen will return a couple hundred. And through that, I could start to look through those. And that's the universe of things I'm looking through. Or you could say, I'm looking for all the net stocks. And, I've run those screens, and I don't invest in every net. I'm just looking for ones that I would be comfortable investing in. And the same thing with a bank. I could say, this is the criteria of the type of bank I like, and I want to invest in that. So something below book value, something that has an efficiency ratio, maybe 70% or less, and then within that universe I'm looking. And so I do limit the things I'm looking at, and that's fine. I want to limit them because I don't have an infinite amount of time, and I also don't want to just fill my mind with a bunch of clutter of things that I'll never, it's like if I'm spending hours reading about companies that I might never invest in, I've just cluttered my mind, and that could, like all that information in there, that could be a spot where I could be confused in the future, where I could say, oh, I think I remember reading about this company, and it was actually a company that wasn't worth investing in, but now I don't want to leave any room for extra information. There's already too much out there. Mm-hmm. So I want actionable, important things. I don't want to just, fill my mind with informational junk food.
Right. So I guess that makes a lot of sense then as to why you wouldn't want to have a watch list then. And also I think it goes along with the lines that you like to pack for your vacation 3 hours before. I'm just going out on a limb there.
You're right. Yeah. Yeah. It's true. A lot of it's my personality type, and I get that. I like, my wife makes fun of me because I'm the type of person where I'll drive somewhere, and the way I go there and the way I come back are completely different. And if I drive to that same place 5 times, the routes I take there and back are different each time. And she's like, well, why are you doing that? And I'm like, I don't even know. It's not something I'm planning on doing. It's happening. And I think that sometimes is true with when I'm looking at stocks. I'm not planning on taking a certain route there or back. I get lost along the way. And so I don't use watch lists because to what I was saying earlier, I don't want to fill my mind with some of that clutter, but I also only want to look at things that I could act on today. So, I'll have some money in my portfolio, we'll say, and I want to invest it. Well, I want to invest it today, and so I want to see what I could purchase today. Not what I could potentially purchase in 5 years or 10 years or 2 years or 2 months, but I want to act on it today. So I look at the universe of what's available right now, and then I act on that. Now, if there's nothing available that I want to buy, then I could wait. But in 2 months, what is available to buy is probably not what I predicted would be available to buy, because I'm terrible at predicting the future. And, if I could, I'd probably be doing, I'd be at a casino betting on red and black, because that's a much quicker and better way to double your money than putting it in stocks if you could predict the future. And, so I'm just looking at what's available now. And I think part of the issue with watch lists and always researching is, for a lot of people, this is their job. And I've been at jobs where my boss wanted me to be doing something because I was paid to be doing something. And the something I was doing, it didn't matter if it was productive or unproductive. I just had to be doing something. And I think there's a lot of doing something happening in the investment world, because there's a lot of people sitting in cubes whose bosses are walking by saying, well, we should be doing something. We're all here. Something needs to be done. And, I understand that. That's just the nature of the beast. For myself, though, I think what happens is, when I've looked at these ideal companies, if I could ever buy this someday, they're great companies that have great brands, and you think, well, if I research this now, in the next crash, I will be able to buy this cheaply, and I'll finally be able to get this great asset at an awesome discount, etc. Well, what always happens for me, and this is, like the animal chasing the shiny thing, when the market does crash, I'm like, why in the world would I buy that awesome asset? Because here's 30 other things that are 80% cheaper. I don't care about that awesome asset, because I could get all these other things that, they're not as awesome, but they're so much cheaper that I'll just load the truck up on those things. And you only know what's available at any given time. So it's like, I can't predict what those not as awesome cheap things are going to be ahead of time. You just have to wait till you're there. And I, in the crisis, I wasn't buying Procter & Gamble or Tiffany's or Coca-Cola or whatever. I was buying nets and other low-price value stocks that ended up doing really well. And then, once we recovered, I started to look at these busted-up names in Japan and overseas, and I wasn't buying Toyota of Japanese stocks. I was buying. I actually can't even pronounce the names of most of the Japanese companies I bought. I have no idea, but thankfully their tickers were all 4-digit numbers, and that was a way to keep track of these things. But I was buying low-priced Japanese stocks, and it's like it didn't matter that you could get Toyota on sale, because I could get something that was trading at a tenth of its true value, and that's what I would rather be investing in.
So another phrase that you've brought up on your blog is this phrase "dead money," and that's something we haven't covered on the podcast yet. So in that article, you argued that dead money stocks can still be valuable. So can you explain what dead money means, and then explain the argument you were making?
Sure. So I think that an investor and an enemy of the investor is, people say it's emotions. That's fine. Emotions are, people have emotional issues. I think it's actually boredom. And this goes back to that always needing to do something. So there's companies out there, a lot of them are OTC companies, that have just traded at depressed valuations for years and decades. And a great example of one of these is Hanover Foods. This is a company I own. They do, if you're on the East Coast, they sell frozen food. They sell frozen waffles, anything frozen. And they're in Hanover, Pennsylvania. And They're trading for like 30% of book value. The company is profitable. It's a few times earnings, and they're just, no one's interested in the stock. Well, the reason no one's interested is because management has decided that they're going to pay themselves lavishly, and there was some issues with there was a fight between some of the family members that own the company, and it became quite vicious. And these guys all paid themselves so well. Well, they were, I like to say, they're robbing the company blind. And while they're robbing it, the company still finds a way to grow book value, and they're still making money. It's not as much as they could if someone came and cleaned it up, but it's still making money, and it's still growing. So this company is traded below book value probably for the last 15 years. And, maybe it'll trade that way for the next 15 or 20 years. But they're still growing at a few percentage points a year. And so you say, no one's interested in a company like this because they say, well, there's no catalyst. It'll never go up. And management's crooks because they're paying themselves some crazy salary. And what if management tries to steal more of the company? And, to that I say, these guys are already making like $12 million a year. They live in Hanover, Pennsylvania. Like at some point, when you're at the top of the food chain, you don't need to go any further. So they're already the kings in town. I think the compensation's kind of topped out. They've got the jet in the small town. It's like, so what else can you do? Well, they're already there. So, the exposure to like more management theft is low, and it's just this cheap company that keeps selling frozen food. I mean, I'd say every couple of weeks we've got bags of Hanover stuff in our freezer because it's on sale, and people buy it. The product is good. It's no different than any other frozen food, and it's just forgotten about. And the enemy of an investment like this is boredom, because you say, wow, I might have to own this 5 years, 10 years, 15 years, 20 years before I ever see a return. And the counterpoint to that is that's true, but if you own something that's growing at, say, 5% a year, eventually the book value is going to double. And then it's going to double again. And so you say, well, now my owning the stock at 30% of book value, now it's 15% of book value. Well, now it's 7% of book value. And presuming the price never changes, which is always the presumption when people say the stock is dead. And so I believe in this idea that value is its own catalyst. So Hanover is clearly not attractive at 30% of book value to the market, because if it was, people would be buying it. You say, okay, well, if 30% of book value of this food company isn't attractive, is 15%. You can buy a profitable company that's doing I don't remember exactly the number of sales, but it's in the hundreds of millions in sales a year. You could buy that for 15% a book. You say, oh, maybe that's not attractive. Maybe 7% a book is when it's attractive. But at some point, the price gets so cheap, it's not going to drop down to 1% of book value or a quarter. It won't go on forever, because at some point, the price becomes so cheap that people say, well, I can ignore any issue that's going on because I can't believe that this price is even real. And when you get that, sentiment suddenly changes, and there's buyers. And when there's buyers, then it's this self-perpetuating thing, and then the price goes up, and then more people are buying it, and it just builds on itself. So stocks that are dead money that people have just given up on because they're so bored, eventually what happens is if the company is growing even a little bit, a few percentage points a year, that growth is going to increase the value gap. And at some point, that gap is going to become the catalyst itself to unlock the value for shareholders. So if you could get over the obsession with doing something or owning something that might not change for a while, then these stocks ultimately could be an incredible investment opportunity if you're just patient enough to sit there and pretend that you don't even own it anymore.
All right, so last question on the blog roll, and it's one that you relatively recently posted, and it's it has to do with, when do you, and I quote, give up on a stock? What does that mean?
Right. So that's kind of what I just talked about. Is a lot of people give up because they're bored, and they are just bored owning a company that continues to execute as it has, and that's no reason to sell out of a position. So if you buy into a stock and the stock, that the company hasn't changed, it's still creating the same products, it's still doing all of the same things it was doing when you bought it, but now it's 3 years later, that's not a reason to sell. The thesis is unchanged essentially at that point. I think a reason to sell and give up on a stock, there's a couple of reasons. The first is if something has changed. So you bought into a company that makes radiators, and then they suddenly decided that they're going to go into solar panels. You say, what is that a good switch? Probably not. And maybe it is, but you were invested in the radiator company, not the solar panel company. So that's a good time to give up and sell. Another time when it's great to give up is when management fails to execute. So, in software, you need to be releasing software in the software world and releasing products. And if you can't get a product out the door, it's a failure of the culture, because you have developers who you could give those developers the same laptop and send them home on a weekend, and they could probably create a minimum viable product and release it doing some of the functionality, get it out the door in a weekend. The problem is if a company that has these developers cannot get the product released, it's a cultural failure. And that's the same with any type of company. So you could say, what if it's a company that makes products? Well, the engineers could design something. We know we have manufacturing processes to build these sort of things, but if we can't get it out the door, there's a cultural failure. And when there's a cultural failure, you want to sell, because unless management, and I'm not talking senior management, all of the company's management leaves, that cultural problem is not going to fix itself. And so that's a failure, and you don't want to be involved in something like that, because they're going to just keep eating money. So a great example of this is all these biotech stocks that they have these great ideas, and then they just always fail to execute on them. And you say, well, what's really going on there? It's a management problem, because then you can look, and there's other companies that are in the same industry that are always able to get drugs done. So it's like, why was Group A able to get it done and Group B was not? It wasn't that Group B's challenge was that much harder, which it could be in some cases, but it's usually not. There's a cultural issue within that company, and that's a sign to pack up and move on to a different opportunity.
Cool. So just to kind of round out here, because I wanted to know, what's your advice for new microcap investors? What would you recommend that they do when wanting to approach potentially investing in microcap stocks?
Sure. So my advice to someone who's new to this is, first of all, to say, if you're new, don't assume that you're going to get up to speed right away and become a genius. So what I mean by this is well, it's funny, because a lot of people will dive into something, and you've seen that there's a famous chart out there, and it's very hard to explain this without the picture, but it's like your perceived knowledge versus your real knowledge, given the amount of you've actually learned. So it's like, when you know the least, you think you know the most, and when you know the most, you think you know the least. And so a lot of times people will dive in, they'll say, oh, here's some company no one else has ever heard about because I just found it and only has a $50 million market cap, and I'm going to mortgage my house and put my whole life savings in it, that it's going to just quadruple from here. That's the wrong approach. The right approach is to say, I found some of these really interesting opportunities. I'm not familiar with the space, so let me get my feet wet, putting in a small amount of money into these positions until I start to learn what's going on. And then as you learn the market, as you learn the dynamics, because the dynamics of small stocks are different than larger stocks, as you start to learn that, then it's appropriate to put more of your net worth into it, to take bigger positions. But when you're starting off, I say the best experience is experience itself. So you need to actually invest your own money and see what happens, but don't put a lot at risk first. So start with small positions and then build up. As you learn more, as you know more, you could invest more. But it's comical and sad reading, but you see it on the internet all the time. Someone will say, I've got 100% of my portfolio in some little company you've never heard of, and they're going to make, it's like a beer cup holder for a lawnmower or something. And it's like, they're on the cusp of a huge breakthrough. Just wait, I'm going to be, buying the top floor penthouse when this happens. And it's like, well, everyone else knows we've seen these stories come and go. And, we know that your investment is going to probably fall 90%. But it's best to learn that with a small position versus going all in on one of these things right off the bat.
Mm-hmm. All right. So Nate, where can my audience go and find more information about you and your blog and, everything, that you have to put out there?
Yeah, for sure. So I write semi-frequently at oddballstocks.com, and we have a premium version of the blog called the Oddball Stocks Newsletter. That's oddballstocksnewsletter.com. And for bankers and bank investors, you could check us out at completebankdata.com. And any of those sites have my contact information. If you wish to contact me directly, send me an email, give me a call. I look forward to chatting.
And also, where are you on Twitter?
Yes. So I have a handle, Oddball Stocks, on Twitter. So I'm very consistent with this.
Well, Nate, thank you so much for joining me today. Thank you for sharing your insights, and I look forward to catching up again soon.
Great. Well, thank you so much for having me on. I really appreciate it.
No, thank you. Have a great weekend.
All right, you too.
Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Nate, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@stocknewsnow.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the Microcap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.